Is this a bubble or the beginning of a new era? Markets are soaring. Tech is back. Retail investors are flooding in. Is this the return of the bull or the calm before the crash? In this in-depth video, we analyze whether the 2025 bull run is built to last or destined to collapse. Subscribe now for weekly insights on investing, market trends, and wealth-building strategies. What is a bull market? A bull market is defined as a sustained period where asset prices, particularly stocks, rise by 20% or more from recent lows. These periods are marked by optimism, investor confidence, and economic growth. Historically, bull markets have followed deep recessions or financial crises, such as the rally following the 2008 financial crisis or the pandemic-induced recovery. Understanding investor psychology during these periods is key. Euphoria can drive prices beyond fundamentals, but it also fuels innovation and market participation. The makings of the 2025 rally. Several key catalysts have contributed to the 2025 bull run. Economic activity rebounded strongly after the pandemic, with a surge in consumer spending and government support. AI and technology innovation have reignited investor enthusiasm, especially around automation, productivity tools, and cloud infrastructure. Additionally, central banks, particularly the Federal Reserve, began easing interest rates again, fueling borrowing and investment. The result? Strong momentum in both growth stocks and broader market indices. Economic fundamentals. For a bull run to be sustainable, underlying economic metrics must support it. As of 2025, GDP is growing steadily, unemployment remains historically low, and corporate profits are robust. Inflation, while elevated in some areas, has moderated due to supply chain normalization. Consumer sentiment surveys and retail sales data show optimism and strong spending habits, further reinforcing upward trends in equity markets. Tech, AI, and innovation boom. Artificial intelligence has emerged as the defining theme of this market cycle. From generative AI tools transforming workplaces to autonomous systems revolutionizing logistics, AI adoption is driving corporate growth and productivity. Companies like NVIDIA, Microsoft, Google, and Tesla are experiencing exponential gains. This innovation boom resembles past tech rallies, but with broader cross-sector applications, from healthcare to energy. The role of the Federal Reserve. The Fed's shift from hawkish tightening to dovish easing played a critical role in reviving risk appetite. After raising rates aggressively in 2022 to 2023, the Fed began cutting rates in late 2024 to stabilize growth. Liquidity returned to markets, and bond yields declined, making equities more attractive. Investors must continue monitoring Fed minutes, dot plots, and economic data that influence rate policy. Contrarian warnings. Is it too hot? Despite the optimism, many analysts caution against irrational exuberance. Valuations in tech and small caps have reached extreme levels. Sentiment indexes are flashing extreme greed. This raises the risk of a pullback or correction, particularly if earnings disappoint or inflation resurfaces. Comparisons are being drawn to the dot-com bubble, making contrarian voices louder. Global macro conditions, geopolitical stability, and global economic cooperation have fueled investor confidence. China's reopening has lifted commodities and manufacturing. The EU's fiscal stimulus is boosting infrastructure spending. However, risks remain. Tensions in Taiwan, oil price shocks from the Middle East, or unexpected election results could derail the rally. Diversified exposure is essential. Retail investors and market structure, retail participation is surging once again, aided by commission-free platforms and financial influencers. Meme stock trading and social media sentiment are back in play. At the same time, algorithmic trading and institutional flows dominate daily volume, often amplifying volatility. Retail enthusiasm is a double-edged sword, great for momentum, but also prone to herd behavior. Strategies to navigate a late-stage bull in potentially late-stage bull markets, prudent strategy matters. Investors rotate from high growth to defensive sectors like healthcare and utilities. Trailing stop-loss orders help lock in gains. Balanced portfolios mix growth with value and include real assets like commodities or REITs. Flexibility and discipline are essential to navigate rising uncertainty. The 2026 scenario: boom or bust. What will 2026 bring? Leading indicators like the yield curve, credit spreads, and insider selling offer early clues. A black swan event, a cyber attack, credit crisis, or geopolitical shock could reverse gains. Alternatively, sustained innovation and global growth could extend the bull market for years. Investors should stay vigilant, diversified, and long-term focused. Subscribe now so you don't miss our upcoming deep dives into the future of money and markets. Is it a rally or a trap? Let's decode it together.